Season 3, Episode 6 of the Your Money Personal Finance Podcast. I'm Peter Cishecki, President of the Everything Financial Group. As I said, Episode 6 today, we're going to work our way through the Omni formula like we've been doing the whole season here, step by step. What is the Omni formula, how it's put together. And today's episode is titled Meet the Portfolio Managers, which is a really exciting episode, which will really show you what we do and how we bring a portfolio manager in to help design the investment side of your financial plan. So without any delays, let's get right into it and meet 3 key portfolio managers that we use to help design the Omni formula at Everything Financial. So let's get into this. We're going to welcome our first guest in the portfolio management segment here with the Your Money Personal Finance Podcast. Today, it's Jeff Gruber from Dixon Mitchell. Welcome, Jeff.
Thanks, Peter. Great to be here.
So we're going to put you on the hot seat today. Don't worry. Don't be scared. I don't bite. So first thing, what we'd like to do is part of this is educating the public on the different portfolio managers we use to do our financial plans. So tell us about Dixon Mitchell, the history of Dixon Mitchell, and just give us the lowdown, the skinny, as they say, on Dixon Mitchell.
Yeah, sure. Thanks. So Dixon Mitchell's been around for 22 years. It was formed in the year 2000 by Rob Mitchell, who at the time was the chief investment officer for, at the time, BC's largest insurance company. And it was at that time that he decided that he was going to take the institutional caliber approach to managing portfolios to the private wealth space, to high net worth individuals. So we started Dixon Mitchell in 2000. We are today 35 people with clients across Canada, but really focused in Western Canada. So we have our head office just down the street on West Hastings at Burrard. We have an office also in Calgary. And in terms of assets, today we're managing just about $4 billion in assets, and that splits roughly 50-50 between the private wealth side and the institutional pension endowment side of it. On the private wealth side, that works out to be there's about 1,300 different households that we work with, and if you think about a typical household with 2 spouses, you easily have 2 TFSAs, 2 RSPs, non-registered, maybe a corporate account. So you easily get 6 to 8 different accounts, and for the most part, most of our clients have all of their investable net worth with Dixon Mitchell. Now, of course, you don't need to, but with your guidance and advice, we can do some really neat things in terms of making sure that the right assets are in the right accounts and really make sure that it's as efficient from a tax point of view as possible. We are completely independent, so we're completely employee owned, and we're continuing to grow.
So on the private wealth side, just so people are clear and they learn from this, that would be like what you do with us at Everything Financial, where we build a financial plan, we refer a client to you and Dixon Mitchell, and then you design the portfolio. That's the private wealth. That's the individual household side.
Correct.
And the institution side is you guys building portfolios and banks, said that word, it just gives me the willies. Banks or later in this segment, we actually have one of our other portfolio management companies coming in, Provisis Wealth Management, and they're an institution then that they represent or they invest money in your portfolios, and that's the institution side. And that allows people who don't really have the minimums, because your company, and I talked about this in earlier episodes about portfolio managers we use, each one has a different shelf space for us in a sense of what their minimums are. And that's good, because that on that institutional side is where I see Provisis and they go, oh, we're going to put some of this client's portfolio in one of the Dixon Mitchell, see, easy for me to say, Dixon Mitchell portfolios. I get excited because I go, I know that company. We work with that company.
Yes.
I know what they stand for, and I know our clients are getting good representation and good management. So it is available to everybody, really.
It is. Yeah. So we sort of broadly define institutional as oftentimes if there's a separate investment committee that's involved in the management of that portfolio. A lot of our clients on the private client side do have corporate accounts. So a lot of them are entrepreneurs, and so they'll have a holding company as part of their overall household assets, but that's not considered an institutional account. It's really, we manage money for publicly traded mutual funds, for large Canadian pensions, and for other large endowments and trusts.
When you say pensions, it kind of brings me into this idea and we talk about this, sometimes a little techie for our clients, but it's part of the way we choose. So what would best describe the style of management that Dixon Mitchell incorporates?
Yeah, so Dixon Mitchell would be described as a classic stocks and bonds investment manager. We are definitely a buy and hold investment manager, and we use what they call a bottom-up approach. So if we take a look at some of those terms...
Sounds like a drinking term I used to do on Friday nights way back when.
Bottom up versus top down. So top down is where you're really focused on what's going to happen in the economy or what's going to happen in the stock market next. So that's, when are we going to go into recession next? When's the next market downturn? The fact is that nobody can consistently time the market. Nobody can consistently predict the
Crystal
market.
Balls don't work? Oh my gosh.
Right? So what we do at Dixon Mitchell is the opposite of top down, which is we focus, the vast majority of our time and resources on a bottom-up approach. So the bottom-up approach is focusing on the individual companies and focusing on where we really can add value. And that's looking through the financials, pouring through, the different line items of revenues, costs, what the management team is seeing on a going forward basis, what kind of risks are there, and really figuring out what the company is all about and what its future prospects are.
That made me think of a couple things when you said time and not timing the market. And that's one thing I talk about all the time to people. Isn't the most important thing time in the market, not timing the market?
Yeah.
I mean, and when you said about the companies you choose, and I've had this conversation because it seems more than ever after COVID, I don't know why, and maybe it's always been there and I haven't noticed, but the conspiracy theory people going down those dark tunnels on the dark web have come out of it, all over the place. And, there's always someone predicting the crash. Like you get these people who predict a crash every single year, and then in 2008 they were right, and all of a sudden they tout
it's
that
the
as
broken clock being right once.
And then they make their book and they make their money and so on. But we had, when I listened to you and listened to some of the other portfolio managers in our office and saying to people like, yeah, we can't predict the market, but people are still going to buy. People are still going to buy their new cell phone. People still buy running shoes. You know what I mean? Yeah. People still go on holidays. And I call it meat and potatoes investing, where you stick with the bread and butter, the meat and potatoes, the basics. There's certain things people are always going to spend money on, right?
Yeah, and there's a great story talking about timing the market. There's a great story that I sometimes share with clients, and that's about a study that Fidelity, the big investment house, did a number of years ago. And so Fidelity in their do-it-yourself investing platform, noticed that there was a group of investors that were consistently doing better than the rest. So the group at Fidelity said, well, let's find out what's going on. What is this group of investors doing better or differently than the rest? And what they found out was that group that was outperforming forgot that they even had an account at Fidelity. So in other words, everybody else that was trying to time the market, trying to get in and
you can't time the market, I know.
What the people that did best were the people that forgot that they had an account, didn't touch it, just left it.
That reminds me of an analogy then. People, investing, remember it's part of your overall financial plan, but investing is like a bar of soap. The more you handle it, the smaller it gets.
Yeah. And I love that. And it's actually a great segue into one of the other things that I talked about in terms of describing our style, which is buy and hold. So
don't wash with it though, just hold it.
Right. And there's so many different things that you lose when you're constantly touching your portfolio, when you're constantly transacting within it. And of course, some of those are just the transaction fees and the commission fees that you're paying. But one of the biggest ones, and ones that I know that you're always hyper focused on too, is the crystallizing of gains specifically in non-registered accounts. So, our approach is definitely a buy and hold type approach. If we were to look at the numbers, about 20% of the portfolio gets turned over per year. And so that includes rebalancing and those sorts of things. So another way of looking at it is our average holding period per position is about 5 years. And we've had positions like Johnson & Johnson that we've held in the portfolio since day one, and have held for obviously very, very extended periods of time.
I'm a fan of Johnson & Johnson. They stuck me twice a few years ago. As we all know what was going on. I happened to be in the States working out of my office there when all that stuff happened. It's like, okay, stick a needle in me. Yeah. But it's interesting you said, and I just want to help educate people a little bit and jump in if I don't get this exactly right. But what does rebalancing mean? And people, when we do our Omni Formula financial plan, and I talked about, we build the plan, the portfolio manager then looks at what we're doing and builds a portfolio to look after the client that fits the plan. So when Jeff talks about rebalancing, and again, if I get a little off, but let's say a standard average, let's say the average portfolio is 40% fixed income, 60% equities, and they're all over the place. That's your guys' department. I'm not involved at all in choosing anything. I just say, need an RSP, need a TFSA, or whatever the case may be. You figure out what goes in that. So what is the normal rebalancing? In other words, if the equity market goes through the roof, because we're now finally recovering, it grows much faster when it does grow over fixed income. So if that 60% becomes, 65, 67, what's the magic number in a portfolio? Because you do buy and hold, where Dixon Mitchell will go, okay, we need to sell off some of those equity things, those holdings, and buy more fixed income so we get back to the 60-40, because I know you guys have discretionary powers. In other words, you can trade the portfolio whenever you want, as much as you want, but you have to keep it within the client's risk level, right? Is that
correct? Yeah, correct. And it's and you actually nailed it. So our threshold,
dumb luck for me.
Our threshold is 5%. So in the case, and it's actually regardless of what the asset mix is for a client, we use 5% as once their maximum equity exposure, which is what we're really focused on, because that's the more volatile,
that's the volatility, right? Yeah,
right, exactly. So once that breaches 5% on the upside or the downside, and I've got an interesting example on the downside for us. So if that 60-40 client with 60% of their portfolio in stocks was at 65%, that would be our trigger to rebalance it. And the reason why we use 5% is that it's a good balance between not rebalancing too much, because again, that bar of soap is going to lose something every time we touch it. So when the markets move and are potentially going to have a move over a period of time, we want to make sure that we capture as much of that as possible. So we don't want to rebalance it right away, but at the same time, there's certain periods, over the course of a market cycle where you can get, 1 to 2% moves a day, and you don't want to be rebalancing your portfolio every other day. So we find 5% tends to be a pretty good trigger or threshold. And it works the other way too. So, that 60-40 portfolio, that 60-40 client in January of 2020, well, by the end of March in 2020, when COVID hit, their
what
portfolio...
Was that? COVID? Don't even remember that, yeah.
Right?
Blocked it out of my mind.
That portfolio, that 60-40 portfolio is now about 50-50.
Right. The market went through the cellar in 6 weeks.
And so in that case, it was actually the bond part of your portfolio that went up in value. And so our approach, because again, that was one of those periods where markets were moving very rapidly, and you were having, or 5% moves in a day. And so, so as part of that, and that's a really big part of being a portfolio manager is having that systematic approach and that systematic application to managing the portfolio, even in times, and especially at times where it literally looks like the world is falling apart. And so we had a systematic way of rebalancing the portfolio every Friday, if a portfolio was 5% out of whack. And so, we were literally within, and this is partly by luck, but also partly by design because it was part of a systematic process. We were literally selling bonds while they were up 10% and using the proceeds of those bonds to buy equities that were down 30%.
Yeah, and look how quick we didn't know the world was a shit show,
right?
How quick it recovered. And we saw that a few months back too, as we went through that horrible drop in September of 2022, where the market dropped right back to where it was pretty much at the end of June, early July 2022. And then October, you have the best single month since 76 or something like that. And all of a sudden you guys are probably on that Friday doing more rebalancing. So and that's why I explain this till I'm blue in the face to people. This is why if your people who's doing your financial plan is not using a portfolio manager, that's exactly why they should be. Because if you think as a planner, you're smart enough to do all those things, you're not. People, I can't do that for you. That's why I checked my ego at the door many years ago, reached out to portfolio management companies and have them do this, because we have a staff designing financial plans. We don't have 40, 50, 60 team members managing portfolios. That's not my expertise.
Well, and I also think it's an interesting case study for people that were managing their own portfolios, right? Because there's a lot of people that are using ETFs.
Oh, they're all great when the market's good.
and it's pretty easy, right, when the market's going up.
Everyone wins.
But, when you look back at March of 2020, if you were managing the portfolio yourself and you were literally just, managing it off the side of your desk because this is not your day job, and, you've never actually gone through a serious downturn, and it always looks...
We had a stretch there. Everything was gold.
Right. So, for people that got out of the market at that time and then decided to get back into the market, maybe, towards the highs or at the highs over the last year or two, and now having the markets back down, I mean, talk about, what's the value added of a portfolio manager and of working with a financial planner. It's really making sure that you're following those goals and that you've got that professional, systematic approach to managing your portfolio.
It's funny because I talked about that in episode 5 when we were doing the episode about why choose a portfolio manager. And I was teaching people to ask the questions. And that even goes back to episode 1 this year when I was saying, what are you getting for your money? So when you're out at the bank and your mutual fund person is getting paid, but they're providing you no service. And I said, people, they have nothing to do with what's inside that portfolio, but they sell it like they do.
Right.
You're not paying them for that. If you're getting paid, if I'm getting paid, because I get money from you guys, the referral fee, you charge a fee. Part of that fee goes to Everything Financial Group. I better be doing something for that money other than just saying, hey, put your money with Jeff Gruber and Dixon Mitchell. That's right. I have to provide the plan. So it's getting value. And that's where I just see it that I just don't get it, why people don't. And one of the other reasons I went to portfolio managers years ago and started doing that. And one of the key things is active management. So I think you've kind of explained it without using that word, but I use that word in TV shows and everything all the time when I'm on air and tell people, look for someone who's actively managing your portfolio. So to the layperson out there just, logging in and looking at this on their computer, what really is active management?
Yeah. So probably the best way to describe active management is to describe the opposite first, which is passive management. And so passive management is where you're essentially investing in an index. Right. Now, you can't actually invest in an index, but you could invest in an ETF, an exchange-traded fund that mirrors or tracks the
just
index.
Copies the market.
Right.
And it's always a day late and $1 short, isn't it?
Right. And And so, how are these indices constructed? And, when we look at the largest, most popular, most widely followed equity indices in the world, they tend to be market cap weighted indices. Right. And so what that means is that, and so for example, probably the most followed equity index in the world is the S&P 500. And that's a market cap weighted index where it takes the 500 most valuable. Now, right? So market cap is the value of the company. So it takes the 500 most valuable companies in the United States. So
that's for the whole world. Just ask them, they'll tell you.
Right. So let's say you buy the S&P 500 ETF. Now, your entire portfolio is based on a single criteria, right? You have exposure to these 500 stocks, but there's only one thing that that was considered, that was used for inclusion in your portfolio, and that's the value of the company. So the value of the company, and of course that's the value of the company today, or in fact even probably a week or
it's probably
a month
out of date
or two.
Somewhat, yeah.
Right. So in other words, your entire portfolio is not considering at all the future prospects of that company. It's not considering the profitability, the future revenue, the amount of
maybe
debt,
they invented a new
solvency.
widget that's going to revolutionize cell phones like we've never seen, or whatever.
Right,
Yeah.
right. So, so it tells you nothing about the future prospects of the company. So I sometimes think of passive investing as taking a pass on doing any sort of fundamental research or any sort of research into it at all. So if that's what passive investing is, active investing, which is what Dixon Mitchell does, is actively analyzing and researching the company's fundamentals, pouring through the financials and understanding exactly what the business is about. Meeting with, we meet, well over 100 different management teams in a typical year, making sure that we understand what the prospects are, what the risks are for the company, and making sure that we've got a really good handle on the upside and the downside for that company. And actually, there's a really interesting story about passive investing and equity indexes in Canada, because if you look at the TSX, over the last number of decades, the largest company in Canada, the most valuable company in Canada, has typically been the Royal Bank of Canada. Mm-hmm. No big surprise there. But every once in a while, there comes along a company that's more valuable than the Royal Bank. And if we look at that history and we go back to the year 2000, we have Nortel. We have RIM, Research in Motion.
Right. That was BlackBerry, people.
Right. Valiant Pharmaceuticals, which is probably a company that a lot of our viewers, a lot of your viewers wouldn't recognize, but was more valuable than Royal Bank of Canada just a number of years ago. And of course, the most recent example has been Shopify. And if we look at Nortel, RIM, and Valiant, they've all gone to zero.
And they've all
right? And Shopify is a more recent example. It's been down 85% from its highs. But so the takeaway from that is, if you would have been an index investor at any one of those periods, at the high, when that company was the most valuable company, the largest position in your portfolio would have been that company, and that company would have gone to zero.
Yeah, and you're screwed.
In a matter of really a short period of time, like typically 2 years in those examples.
Well, you say institutions. So people at big institutions, and I see this all the time, and I think this one's an easy one for you. They spread rumors out there all the time that, and I always use the short-term portfolio manager, technically investment counsel planning model. But anyways, they say your money's not safe going to these independents, going to these portfolio managers. Now, that's not true. That's just a scare tactic, right? Because I've talked previously about custodian. Mm-hmm. So they just use that as scare tactics, right?
Yeah, to be honest with you, I've never come across that. But
I've seen it lots.
It might be just because if we're considered the competition, they don't say it in front of my company. But I mean, I think it is an interesting opportunity to talk about how portfolio managers, how firms like Dixon Mitchell work on the back end. And so when you become a client of Dixon Mitchell, you're really becoming a client of two different institutions. You're becoming a client of Dixon Mitchell for investment advice. That's what the counsel part of it, and investment counsel is. But you're also becoming a client of a custodian, and a custodian is just the entity
I call it the
that
vault.
is. Right, the vault, the entity that's holding your assets, right? So it's so picture like a bank,
Right.
And so what happens is you deposit or transfer your assets into the custodian entity, and then you give Dixon Mitchell written authorization to make investment decisions on your behalf.
But the money stays in the pot.
But the money stays
vault.
there, and Dixon Mitchell does not have authorization to transfer your entire portfolio and its assets to Dixon Mitchell's own account. So, I mean, I sometimes imagine in a worst case scenario where you show up to the 16th floor of the Guinness Tower in Vancouver, the headquarters of Dixon Mitchell, and there's literally nobody there. Well, your assets that are at the custodian. Right. Your assets that are at the custodian, and we use several different custodians, but National Bank being one of them, one of Canada's largest banks. So you've got, one of Canada's largest banks and all of the infrastructure and IT and security, and of course their, Canadian Investor Protection Fund secured. So you've got all of those safeguards around your assets, similar to working with any other major institution, financial institution in Canada.
Okay, let's wrap this one up with the big question of the day. Don't blow smoke up my you-know-what.
Yeah.
But for our listeners, because like us, we choose clients, we interview them, we want to make sure we're a good fit.
Right.
So why did you agree to work with Everything Financial and myself?
Well, Peter, we've been working together for just over 5 years, and actually, I love the story that describes how we connect. Because one morning, one of my colleagues came into my office and said, I was driving in and I just heard this guy, Peter Cishecki,
Geez, we're going way back.
talking on the radio, and he was doing a financial planning segment, and he's doing some really neat things. You should try and get a hold of him. So I got you on the phone, and you said, geez, this is so funny, because I was literally just speaking to one of my financial planning colleagues,
the guy
and they
I
were
went to high school with,
right, and he was just talking about all of the great things that you guys are doing at Dixon Mitchell. But I think the reason why the relationship works so well is because you're so focused on the big picture, the 30,000-foot strategy, right, and it's all about reducing taxes, because that's the one thing that you have control over. And then Dixon Mitchell on the other side is really just part of that, executing that one part of the plan and just making those day-to-day investment decisions. So, I think we're both really doing well at what we specialize in and where our expertise is. And I think it works really well.
Well, I want to thank you for your time coming in. It wasn't nearly as scary as you thought, was it? It's not that bad.
Thanks, Peter.
Great information for you people listening and viewing in and logging in to Everything Financial on YouTube. I want to thank Jeff Gruber, Dixon Mitchell for his time. I know our clients love him and his firm and what they do, and it's not about rate of return. It's about education and the strategy that fits our financial plan strategy. So now that you've done it, hopefully we can commit to having you come in again, and we'll go over a different topic next time.
Absolutely. We'd love to.
Thanks a lot.